Greetings, my financial warriors and fellow keyboard economists, and welcome back to Boss Economics World. Well. What in the holy name of Paul Volcker is going on? The date is September 1st, 2025, and gold is knocking on the door of $3,500 an ounce. For our younger viewers, that's not a typo. That's not the price of a used car. That's the price of one single, solitary ounce of shiny yellow metal. So, the question isn't why gold is at an all-time high. The real question is why it isn't at $5,000 yet. Because what we're witnessing, ladies and gentlemen, isn't a bull market in gold. It's a complete and utter vote of no confidence in the foundational pillars of the American, and by extension, the global economic system. Let's dissect this beautiful disaster, shall we? From point to surface. Our headline story is, of course, the political soap opera that has the entire financial world binge-watching in horror, the emergency hearing over President Trump's attempt to fire Federal Reserve Governor Lisa Cook. A decision is pending. The fate of the world's most powerful central bank hangs in the balance, swaying on the whims of a single judge. Let's be crystal clear about what this means. This isn't just a personnel dispute. This is a five-alarm fire at the very heart of modern capitalism. The independence of a central bank is not some esoteric academic theory, it is the bedrock of a stable currency. It's the institutional firewall that prevents politicians of any party from printing money to fund their pet projects, finance their wars, or juice the economy right before an election, consequences be damned. When that firewall is breached, you don't have to look far to see the result. You can pull up a history book, or you can just look at a live chart of the Turkish lira over the past decade. President Erdogan treated the central bank like his personal ATM, firing governors who wouldn't slash rates, and in the process, he incinerated the savings of his people with 80% plus inflation. Or look at Argentina, a country that has been playing this game for so long they should get a trophy for it, lurching from one currency crisis to the next. This is the Banana Republic Playbook, Chapter 1. And now, it's being rehearsed on the world's main stage. The markets are screaming this at us. The surge in gold isn't just about a potential Fed rate cut in September, that's the small, tactical story. The big, strategic story is the existential risk. Investors are no longer just hedging against inflation, they are hedging against a full-blown institutional collapse. They are buying gold as insurance against the possibility that the U.S. Federal Reserve becomes a political puppet, and the U.S. dollar becomes a political tool. Capital is a coward. It flees from uncertainty and chaos. We are already seeing the tremors. The latest data from the Treasury International Capital (TIC) system, even before this crisis, showed a marked slowdown in foreign central bank purchases of U.S. Treasuries. In the second quarter of 2025, net foreign purchases were the lowest since the 2020 pandemic scare. This isn't just a trend, it's an evacuation. Now, zoom out from the Fed and look at the other headline. A federal appeals court has ruled the president's global tariffs were illegally imposed. But in a move of pure, uncut 2025 absurdity, the judges are letting the illegal levies stay in place. This is policymaking as a Jackson Pollock painting, splatter everywhere, no discernible logic, and an absolute mess to clean up. For businesses trying to manage global supply chains, this is a nightmare. How can you sign a 5-year contract with a supplier when you have no idea if a 25% emergency tariff will be slapped on your inputs by a tweet tomorrow morning, upheld by a court that agrees it's illegal? You can't. So you don't invest. You don't hire. You wait. And what's the result of waiting? Look at this week's key jobs report forecast. Economists expect a measly 75,000 jobs added in August. In a healthy economy, that's a rounding error. Here, it's a giant red flag. The unemployment rate is ticking up. This is the stagnation part of the equation. And the inflation part? Well, the tariffs take care of that. As we learned the hard way from the 2018 to 2019 trade wars, backed by numerous studies from the National Bureau of Economic Research, NBR, which showed the full cost was passed on to U.S. consumers and businesses, tariffs are just taxes on your own people. They are an injection of cost-push inflation directly into the veins of the economy. So you have the Fed, pressured by a slowing economy, made worse by tariff uncertainty, about to cut interest rates. But you also have stubborn inflation, made worse by the tariffs themselves. Slower growth and higher prices. Ladies and gentlemen, please give a warm welcome back to our least favorite guest from the 1970s, Stagflation. Fed President Mary Daly can suggest the inflation from tariffs is temporary, but that's like a firefighter saying a house fire is temporary while someone is actively pouring gasoline on it. Now, let's connect these dots and paint the masterpiece of this economic tragicomedy. For decades, the world has operated under the US dollar's exorbitant privilege. America could run massive deficits because the world needed dollars to trade, to save, and to invest. This privilege rested on two unshakable pillars. 1. The full faith and credit of the US government, backed by an independent Federal Reserve committed to a stable currency. 2. A predictable, rules-based legal and economic system underpinned by the rule of law. In the span of one news cycle, we see both pillars being actively dismantled. Not by a foreign adversary, but from within. The attack on the Fed's independence erodes Pillar 1. The illegal but will allow it tariff chaos pulverizes Pillar 2. The de-dollarization narrative, once a fringe theory whispered in the corners of the internet, is now mainstream policy for a growing portion of the world. And we're handing them the playbook. Look at the data. The World Gold Council has been reporting record-shattering levels of central bank gold purchases for the last 3 years running. In 2023 and 2024, central banks collectively bought over 1,000 tons of gold each year. Who were the biggest buyers? China, India, Turkey, Singapore, nations actively seeking an alternative to holding all their wealth in US dollar assets. They see the political dysfunction. They see the weaponization of the financial system. And now, they see the US government cannibalizing its own most precious institutions. They aren't just buying gold because it's pretty. They are buying it because it is a monetary asset that is no one else's liability. It cannot be devalued by a late-night tweet or a politically motivated rate cut. The price of gold at $3,445 is not a signal of the strength of gold. It is a fever chart for the health of the global financial system, and the patient is delirious. Silver hitting $40 an ounce isn't just about industrial demand, it's the poor man's gold catching the same safety bid. So, as we head into this week, yes, the jobs report matters. But it's like meticulously checking the tire pressure on a car that's already on fire and heading for a cliff. The micro data points are being overwhelmed by the macro political implosion. What we are witnessing is a historic repricing of sovereign risk. For the first time in nearly a century, the markets are being forced to put a real, quantifiable risk premium on the United States itself. And that premium, my friends, is spelled GOLD. So buckle up. The coming months won't be about navigating economic cycles. They'll be about navigating a crisis of faith in the very system that has underwritten global prosperity for 80 years. Stay cynical and stay diversified. I'll see you next time.